Hello, I'm Ryan Lightfoot Amanoff of Chelsea Financial Services, and today I'm joined by Dr. Niall O'Connor, manager of the Brooks Macdonald Defensive Capital Fund. Niall, thank you very much for your time today.
Good morning.
Now, back in June 2020, you very rightly predicted that we were going to get inflation. Haircuts, holidays would get a lot more expensive. What are your thoughts on inflation today, a year and a half on? Do you think it's transitory or not? And do you have a position in the portfolio for inflation that has paid off in any way?
Yeah, sure. Well, that inflation thesis was really based off the fact that there was going to be less supply available. The whole idea, maybe the haircut was a little bit of a trivial idea, but if you've got less space in a hairdresser, if people have to be spaced out, there's less availability of it. There's going to be as much demand and maybe some more pent-up demand. So it wasn't surprising to us that we were predicting even at the time that we'd see inflation on a lot of goods. You're seeing it bubbling up all over the place with supply chain issues and so on. But I think it's definitely not a transitory phenomenon. I think we're already well past that point. There is clearly a shorter term element to it, which is just all of this pent up demand feeding through. So I don't really see sort of 6% inflation being the norm in future, but I don't really see by the same token 3 or 4%. I wouldn't think that's impossible. The slight issue as well is that which are central banks are just scared to raise rates at the moment. Nobody really wants to be seen to be spoiling the party. And if rates don't get raised, then inflation is going to carry on for longer and higher than people are thinking at the moment. And so I think inflation is more of a structurally higher issue going forwards. We reduced the sensitivity of the fund to inflation to its lowest level ever. So effectively the duration of the fund, i.e. the sensitivity of the fund, is now below 1 year. It's the lowest ever level we've had. And on the other side of the equation, apart from taking away the sensitivity to inflation, we've invested in more inflation-linked assets. So for instance, our real assets allocation has gone from around 16% to nearly 30% now. And we've invested in things like renewable energy companies. One good example, UK Wind, where 60% of the revenues are actually from the government, and they're explicitly RPI linked. And I'm scratching my head a little bit because we own two of these that have a dividend yield of more than 7%. And if you look at index linked gilts, which is your risk-free way of getting inflation protection, they're yielding around -3. So there's a 10% gap in yield between renewable energy companies and index linked gilts. And I just feel that's wrong. I think those energy companies are just way too cheap.
And you're also quite cautious about the dividend recovery. Obviously, we saw huge cuts in dividends last year. Have they recovered better than you'd expected, or is it around about sort of what you thought would come through?
Well, that's right. Dividends did recover very slowly. And what we saw really looking at markets was that I don't think anybody really anticipated how much the dividends were going to be cut. And they've recovered quite slowly. So if you look at FTSE dividend futures, suggesting the dividend yield on the FTSE for this year is only going to be around 3.3. So that's well below where most people would have expected in the sort of 4 to 4.5 year range. Futures markets were much more bearish than that still. So we actually bought some 2022 FTSE dividend futures, and they've rallied over 40% since. And I think there's still a bit more upside. But yes, the recovery has been a lot slower than people originally anticipated.
And at the time, you were looking for sort of safe yield in places like real estate, investment trusts, and high yield bonds. You talked a little bit about buying real assets for inflation, but are you still seeing that sort of safe yield with them today?
Yeah, that's right. So because we anticipated a very low FTSE dividend yield, that made REITs with their relatively high yields and also high yield bonds look very attractive, especially on a relative basis. So we did invest quite a lot of REITs and also in high yield. And REITs did, in fact, do extraordinarily well as people realised government bailed out most tenants and dividends were either carried on or resumed for a lot of REITs. And likewise, in the high yield space, almost no high yield companies went bust because governments and central banks just bailed everybody out. Now, that's a little bit less true today. You do have to be a bit more choosy because many of our REITs have rallied very strongly. So we were buying REITs at around a 30% discount. Some of them even got to 50% discounts. And a lot of those have rallied and are now trading much closer to their NAVs. So any of those that have sold to NAV, any of those that traded close to NAV, we've either trimmed or sold those. But there's still plenty of REITs out there that still look very attractive. especially if you think we're in a higher inflationary world, because a lot of those REITs have rental income streams which are either implicitly or explicitly linked to inflation. But you do have to be a bit more picky, but in a couple of examples I'd give there, Empiric Student Properties is still on a 23% discount, and Standard Life Investment Properties also on a 23% discount, and that's actually pretty much an industrial REIT. On the high yield side, things do look much more fully valued now. So we much prefer things like lending funds. These are investment trusts lending to companies. It looks a bit like high yield, but we get much better yields. Dividend yield in that space is over 7%. And then also in the equity CLO space, where you're getting, again, a much more yield pickup. So much better risk reward characteristics there. Fair Oaks Income would be our favorite there on a 15% yield.
And you've got quite a lot of these things in the funds called autocalls. It's not often what we see from some of our other funds. So maybe you can explain sort of what they are, what the purpose of them is in the portfolio, please.
Sure. They're sometimes better known as structured products. In simple terms, they're issued by investment banks and they're based on major equity indices. So, for instance, you might buy a FTSE autocall, and that would pay, typically in these markets now, about a 6% annual coupon. With the proviso that the FTSE has to be at 60% or more of its initial level on the 6th anniversary. So as long as the FTSE doesn't have more than a 40% drawdown over that period, or is down more than 40% on the 6th anniversary, you collect a 6% coupon. If it's down more than 40%, you get the FTSE return. So your worst outcome is that you end up with the equity return. Your best outcome is that you're getting a 6% annual coupon. And in between, they behave a little bit like a lower volatility version of the index. So they really work best where markets are sort of flat or sideways, because then basically you're just collecting your 6% coupon and everyone else isn't making money or losing money. So, good example, last year our autocall basket was actually up around 1%, despite the fact the FTSE was down 14%. And this year, even in quite a good year, obviously, for the FTSE, our autocall basket's actually up ahead of the FTSE. So, normally they work best in sideways or downwards markets. What's been quite interesting here, though, is that the investment banks got their calculations very, very wrong, and they lost hundreds of millions of euros, interestingly enough, mainly on dividends, which is why you saw so much pressure on dividend futures. So the investment banks' pricing of these has been very poor. So it's very expensive to buy new issues. So we haven't actually been buying any more, and that book has run down a bit. But it just sort of shows the advantage of running a multi-asset portfolio. You can see, if things look cheap, you can buy more. So REITs look very attractive, and when things look expensive, like autocalls, we're not forced buyers of them. We can just let that book run off a little bit.
Thank you. So we've talked about sort of a variety of different products you've got in the portfolio, some of renewables, some of real estate. One name that stood out in your top 10 is a company called Roundhill Music. What's that doing in a defensive capital fund? What's the benefit of having that?
Sure. Well, Roundhill Music is very similar to the better known Hypnosis Songs Fund. And what it's doing is basically it's buying up music rights. It's the writer's share to music rights. So they're basically, it's like a royalty company. They're just receiving a royalty stream every time a song's played. And of course, revenues in the music world are increasingly coming from streaming, and streaming is growing very, very quickly. So Spotify revenues, for instance, growing about 20% a year. Now, I think one thing that people get wrong on this a little bit is they think of songs as being an annuity. But they really aren't. So there's always a preference, obviously, for listening to newer songs. So the example I always give here is Rihanna's Umbrella. And of course, the year that was out, you'd hear it 10 times a day. These days, you rarely hear it anymore. So what actually happens is revenues fall over time as songs fade from memory. So it's not an annuity stream at all. And what you really want is a catalogue which is better aged. In other words, the revenues aren't falling as fast. And what we really like about Roundhill is it's a much better aged catalogue. It's got songs in it like What a Wonderful World, which you might hear 4 times a year, but you'll hear it 4 times next year and 4 times the year after that. So it's much more an annuity type revenue stream. And Roundhill's catalogue is very much more focused on songs like that, and classic rock, and much less on modern pop, where you'd see the revenues fall. So we think the catalogue has much greater value, should be valued at a much higher multiple than Hypnosis is. But in the market, if you look, they're valued around the same. But whichever way you look at it, it's a fantastic industry because you've just got this brilliant tailwind of growth from increasing spending on music.
And I imagine very diversified to the other things you've got in the portfolio.
Well, that's the other nice thing about it. Yes, it should be quite market neutral. It should do something very different to an equity fund or a lending fund because music just does its own thing.
Well, Niall, that's been really interesting. Thank you very much for your time today.
Thank you very much.
And if you'd like to find out more about the Brooks Macdonald Defensive Capital Funds, please visit our website, chelseafs.co.uk. And for more from our video series, don't forget to like and subscribe below.